Hi everyone, I'm attorney Aiden Durham with 180 Law Co. in Denver, Colorado, and welcome back to All Up in Your Business. In this episode of All Up in Your Business, we're going to talk a little bit about the Qualified Business Income Tax Deduction. Since we're coming up into tax time pretty soon, this is a topic that's been on a lot of people's minds and a lot of conversations as we're preparing to file our taxes. So I'm going to give a little overview of the QBI deduction and how it might work in your business. But before we get into it, please be sure to like, subscribe, and share. Also, be sure to check the description. I've got some freebie downloadable guides and check sheets and stuff there. So the Qualified Business Income Deduction, or the QBI deduction, it allows non-corporate tax rate payers to deduct up to 20% of their qualified business income. Now, when I say non-corporate tax rate payers, that essentially means just any business that isn't taxed as a C corporation. So this will apply most commonly to sole proprietorships, general partnerships, LLCs, and then entities that are taxed as an S corporation. So if you're in one of those situations with the QBI deduction, you can potentially take up to 20% of your QBI, your qualified business income, as a deduction. The term qualified business income, that has a special meaning to the IRS. The IRS says that the QBI is the net amount of qualified items of income, gain, deduction, and loss from any qualified trade or business. It only includes things that are qualified as taxable income and doesn't typically apply to passive sources of income, such as interest or dividends or capital gains. Those usually aren't considered in the qualified business income. Essentially, you have to be engaged in the business or the trade on a regular and continuous basis in order for it to be counted as qualified business income. And then the qualified business income is basically like the business's net profits, the income minus the expenses. So if you have qualified business income and you fall under one of these pass-through entities like a sole proprietorship, LLC, S corporation, then you're eligible to take the qualified business income tax deduction. So exactly how it's going to apply and be calculated is going to depend on your income level. And I'm talking about your total taxable income, not just your qualified business income. So if we're looking at this on our actual tax returns, we would usually list the qualified business income. That would be on Schedule C. That's where we list out the income and losses and other deductions for the business itself. And then that number is transferred onto the Form 1040, which is where we calculate our adjusted gross income. So it's that total taxable income and not just the qualified business income that's going to be subject to the IRS's limits. For the year 2019, so for reporting your taxes for 2019, those income limits for a single person, $160,700 or $321,400 for married people filing jointly. And now those thresholds, that income threshold, that is before taking into account the qualified business income tax deduction. So that number of that limit is based off of before you've factored in the QBI deduction. For 2020, so next year when we're reporting our taxes for 2020, those limits are going to be a little bit higher. It's going to be $163,300 for single people and $326,600 for married. Now, if you operate multiple businesses, you may be able to, or in some instances, you might actually be required to aggregate those businesses for the QBI. In other words, combining the activities of all of the businesses to take advantage of the QBI deduction. So if you have 3 different businesses that you're running, you basically can total up their qualified business income and then take that 20% deduction on the aggregate or total amount. Now, this is typically only an option if the person or same persons owned more than 50% of the business for a majority of the tax year. And along with that, one or both of these other factors need to be met. Either the business provides products or services that are typically offered together. They share centralized business elements or facilities, and or they're operated in coordination with one or more of the other businesses. So that's often going to apply for us solo business owners who may have multiple operations going. It gets a little bit more complicated once you go over those income thresholds, particularly if you're in a specified service trade or business, which is pretty much like lawyers, accountants, doctors, health professionals, dentists, financial advisors, consultants. Those types of professional services or trades are excluded from the QBI deduction once you've reached the upper limit of the income threshold. So if you're above that threshold of $160,000, but you're below the upper threshold, which is about $210,000, then your deduction, what you can take as the QBI deduction, starts to get reduced. And the way it gets reduced and the calculations for that are beyond the scope of this video. And if you're in that situation, you should be working with an accountant or a tax professional anyway. So ask them how to do it. And then if you're over that upper threshold, that $210,000 threshold, and you're in one of these specified service trades or businesses, you're in one of these professional categories, then you lose the opportunity to take the QBI altogether. So a few key takeaways about the qualified business income tax deduction or the QBI deduction. Number one, you have to be a pass-through entity. You can't be a C corporation. You've got to be either a sole proprietorship, partnership, LLC, or taxed as an S corp. There are other types of things like trusts and other vehicles that qualify for the QBI, but for the purposes of this video, I'm not referencing any of those. You can still take any other allowable business deductions on your Schedule C in addition to this qualified business income tax deduction. If your business doesn't have an income, if your qualified business income is actually a negative, you can carry over that loss to the next year. So even if you can't take advantage of that QBI deduction because there's no income, you can still move it forward to next year and potentially use that loss to your advantage for next year's taxes. The QBI deduction allows you to take a below-the-line deduction of up to 20% of your qualified business income. And then finally, the deduction and how it would be calculated and applied is subject to these income threshold limits and, may be adjusted according to all of that. And so if you are trying to take advantage of the QBI deduction, there are other things that you might be able to do to lower your total taxable income. And I'm going to talk about what those things are in the next video, so make sure you watch that and make sure you subscribe so you don't miss it when I put it out. That's all for this episode. Please drop a comment below and let me know what you think. Keep in mind, I'm not a CPA and I'm hardly a tax expert. I know just about the basics of taxes when it comes to business and all that, but I'm no tax expert. So don't ask me your complicated tax questions or anything like that because I don't know. Also, be sure to check out my blog for additional information on running your business and all of that. Thank you all so much for watching. I'm Aiden Durham, and I'll see you next time.